Ever wondered what makes a successful trader stand out in the world of leveraged trading? In the dynamic realm of financial markets, leveraged trading offers a unique opportunity. It's like a double-edged sword, offering the potential for substantial profits, but also the risk of significant losses. Leverage trading is a strategy where traders use borrowed capital to increase their potential return on investment. It amplifies the outcomes, both profits and losses. This is why it's crucial to understand the indicators before entering a deal. Indicators are like the compass and map in the vast ocean of trading. They help traders navigate market trends, identify potential opportunities, and mitigate risks. They are the key to unlocking the true potential of leveraged trading. Knowledge is power, and in the world of leveraged trading, understanding these indicators is the power to make informed decisions, to minimize risks, and to maximize profits. So, stay tuned to unravel the 10 most important indicators for entering a deal in leveraged trading. First off, let's dive into moving averages, a crucial indicator for traders. In the world of trading, moving averages are like compasses, guiding traders through the choppy waters of the stock market. They represent an average value of a security over a set period of time, helping to smooth out price fluctuations and offer a clearer picture of the market trend. There are two main types: the simple moving average, or SMA, and the exponential moving average, EMA. The SMA calculates an average of price data, while the EMA gives more weight to recent data. Why are they so important? Well, moving averages can help identify potential buy and sell signals. When the price crosses above the moving average, it might be a good time to buy. Conversely, when it drops below, it might be time to sell. Mastering moving averages can be your first step towards successful trading. Next up is the Relative Strength Index, a momentum oscillator that measures speed and change of price movements. Known in the trading world simply as the RSI, this tool is a staple in any trader's kit. It's the measure of the speed and change of price movements, providing a value between 0 and 100. When the RSI crosses above 70, that's generally considered an overbought condition. In contrast, when it drops below 30, that's seen as an oversold condition. This can hint at a future price reversal, offering potential buy or sell opportunities. But remember, while the RSI can be incredibly useful, it should not be used in isolation. Combining it with other indicators can give you a more accurate reading of the market's pulse. So, why is the RSI important in leveraged trading? Well, it allows you to gauge the market's momentum. It can provide a snapshot of whether the bulls or bears are in control, helping you make more informed trading decisions. Understanding the RSI can help you gauge the market's momentum. Let's look at the MACD indicator, a trend-following momentum indicator. Now, MACD stands for Moving Average Convergence Divergence. Quite the mouthful, right? But don't let that intimidate you. In essence, it's all about showing the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. The result is then plotted on a chart with an EMA of the MACD itself, known as the signal line. When the MACD crosses above the signal line, it's often seen as a bullish sign, suggesting it might be a good time to buy. Conversely, when it crosses below, it's a bearish sign, indicating a potential sell signal. This indicator is particularly useful for understanding market momentum and spotting potential reversals before they happen. It's a favorite among many traders for its simplicity and effectiveness. The MACD is a potent tool for spotting changes in market trends. Now, let's delve into Bollinger Bands and the Stochastic Oscillator. Bollinger Bands and the Stochastic Oscillator are two essential tools that traders often use to make better-informed decisions. Let's begin with Bollinger Bands, a volatility indicator developed by John Bollinger in the early 1980s. Bollinger Bands consist of a simple moving average sandwiched between two standard deviation lines. These bands expand and contract based on market volatility. When the market is calm, the bands contract, and when the market is volatile, they expand. This expansion and contraction can help traders identify potential buy and sell signals. For instance, a price touching the upper band could indicate an overbought condition, while a price touching the lower band could suggest an oversold condition. Now, let's pivot to the Stochastic Oscillator, a momentum indicator that compares a particular closing price of a security to a range of its prices over a certain period. The Stochastic Oscillator is presented as two lines. The main line is called %K, and the second line, called %D, is a moving average of %K. When the %K line crosses above the %D line, it generates a buy signal, and when it crosses below the %D line, it signals a sell. However, just like Bollinger Bands, the stochastic oscillator can also indicate overbought or oversold conditions. If the %K line is above 80, the security may be overbought, and if it's below 20, it may be oversold. While both Bollinger Bands and the stochastic oscillator can provide critical market insights, they serve different purposes. Bollinger Bands primarily focus on price volatility, while the stochastic oscillator emphasizes price momentum. Therefore, using these two indicators in conjunction can offer a more comprehensive view of the market. In leveraged trading, where the stakes are high, these indicators can be invaluable. They can help traders identify potential entry and exit points, thereby maximizing their profit potential and minimizing their risk. Both Bollinger Bands and the stochastic oscillator can provide valuable insights into market volatility. Finally, let's explore Fibonacci retracements, volume Ichimoku cloud, on-balance volume OBV, and average true range ATR. Starting with Fibonacci retracements, an indicator that's as intriguing as its name. This tool is based on the Fibonacci sequence, an infinite sequence of numbers where each number is the sum of the two preceding ones. In trading, these ratios are used to identify potential retracement levels. These levels are seen as significant support or resistance lines where price could reverse. The most common Fibonacci retracement levels are 61.8%, 50%, and 38.2%. Moving on to volume, an indicator that is as straightforward as it sounds. It represents the total number of shares or contracts traded within a specified time frame. Volume is used by traders to gauge the strength of a trend. Think of it as the fuel that drives the market. A high volume indicates strong investor interest and a high likelihood of trend continuation. Next, we have the Ichimoku cloud. This Japanese indicator provides a comprehensive look at the market's equilibrium, giving traders a full picture at a glance. It's a combination of 5 lines, each giving unique information about the price trends. The cloud itself is the space between two of these lines and is typically shaded on charts, creating a cloud effect. If the price is above the cloud, the trend is likely up, and if it's below, the trend is likely down. Next in line is on-balance volume, or OBV. This indicator uses volume flow to predict changes in stock price. It's a cumulative total that adds volume on up days and subtracts volume on down days. Traders use this indicator to confirm the strength of a trend. If the OBV is rising, it suggests that buyers are willing to step in and push the price higher. Lastly, we have the average true range, or ATR. This indicator measures market volatility. It does so by decomposing the entire range of an asset price for that period. High ATR values mean high volatility and may signal market tops or bottoms. Low ATR values indicate low volatility and may represent a continuation of the current trend. All these indicators, when understood and used correctly, can provide significant insights into market dynamics. They can help traders determine the trend direction, gauge volatility, and identify potential reversal points. Remember, no single indicator can provide all the answers. It's the combination and interpretation of these indicators that can guide you in making strategic trading decisions. By understanding these indicators, you can make more informed decisions in leveraged trading. Let's recap what we've learned about the 10 most important indicators for leveraged trading. We started with moving averages, a tool that helps determine the overall trend of the market over a specific period. Then we dove into the Relative Strength Index, or RSI, which measures the speed and change of price movements. Next up was the MACD, which reveals changes in the strength, direction, momentum, and duration of a trend in a stock's price. We also touched on the Bollinger Bands and Stochastic Oscillator, which are used to identify overbought or oversold conditions in the market. Finally, we discussed Fibonacci retracements, volume, Ichimoku cloud, on-balance volume, and average true range. These indicators help to identify potential reversal points, measure market interest, predict price movements, and assess the market volatility. All these tools, when used correctly, can provide significant insights into the market, aiding your decision-making process. Remember, understanding these indicators can be your key to successful leveraged trading. Until next time, happy trading!